Welcome everyone to Wealth Office Hours Live. Excited to be with you today. As we're getting started, I want to know an important question for those of you on right now. How many of you have an LLC? Chime into the comments and maybe even list the state where your LLC is located. This is what we're going to be talking about today is LLCs from A to Z. We're going to be covering how to structure these, how you might use them with an IRA, what are the asset protection rules, what are the tax rules, how do I benefit from an LLC? But also we have a cutting edge topic, a very important topic for any of you who use LLCs for real estate. There is a new federal law going into effect that applies to real estate investors using an LLC, and you need to understand this rule. So starting March 1st, 2026, FinCEN, this is the Financial Crime Enforcement Network, is implementing a new nationwide rule. This is called the Residential Real Estate Reporting Rule. Some of you might remember FinCEN from the BOI rule that was about 3 to 6 months ago. The BOI rule is about anyone that had an LLC or corporation, you had to file a report to the federal government saying who owned this entity. Now that went to the courts, went all the way up to the US Supreme Court, and eventually they didn't rule on it. Still waiting a decision, but the Trump administration came out and said, we're not enforcing this anyways. It's now a non-issue. So the BOI rule died, but you might have heard of FinCEN from this BOI rule, where there was another rule that came out from this same legislation, the Corporate Transparency Act, that was supposed to be implemented by FinCEN. This other rule is called the Real Estate Reporting Rule. And what the Real Estate Reporting Rule is trying to understand is who owns LLCs when you're transferring real estate around from individuals to LLCs or LLCs to LLCs. Okay, so that's what this Real Estate Reporting Rule is about. Now, Congress, in their wise, ways, I'm joking there, but Congress, their whole theory here was there's a lot of money laundering happening. People are using LLCs and they're improperly laundering money or doing financial crimes by transferring real estate around. And what they're trying to get at with this rule is providing disclosure and transparency of who actually owns these LLCs. They're trying to prevent money laundering, all this illicit financing, and all these bad things that are happening out there in the world. Now, this rule goes into effect March 1st, 2026. This is a nationwide rule. Now, the goal here is we're going to talk about this rule as we go through the day today. I'm going to show you actual real estate report you have to file. But we're going to go over here, and what we're going to break down is who FinCEN actually is, how this rule is different from the BOI rule, what the rule is going to require. There's actually something you're going to have to file now when you're moving properties into an LLC. There are some exceptions. We'll go over some of those exceptions, but also what are you doing as an investor and what burden is this putting on you? Now, this is not in effect yet. So for any properties already in LLCs that you own as a real estate investor, don't worry about those. But for any new transfers of real estate into an LLC starting March 1st, 2026, you need to know this rule. Now, when you're buying real estate, and this is the first exception. Let's say you're buying real estate and you're using a bank and financing it. This rule is not for you. If there's a bank involved, FinCEN and financial organizations are already being notified, frankly. Your Social Security is already being ran by the bank or the mortgage company that's providing traditional financing to you. But if you have closed in your personal name with other financing and now you're transferring it to an LLC, there's no bank involved, and this is creative financing, or you're transferring it from your personal name to your own LLC, you're going to fall under this rule. All right, now FinCEN, who are they? FinCEN is the Financial Crimes Enforcement Network. This is a combination of federal agencies that are there to help stop financial crimes. And they enforce rules like this. They also enforce rules for banks, like the Bank Secrecy Act, and banks have to disclose who own bank accounts. They have to report suspicious activity in bank accounts. But this rule is going to start hitting title companies, deed preparers, lawyers, real estate investors who are transferring properties to LLCs. All right, now this rule says you must file this thing called a real estate report. This real estate report has 5 sections. And we're going to actually look at what this real estate report is in a second here, and I want to pull this up on the screen if you guys just look at it, but there's 5 sections in this, all right? The first section, and let's get that up here once we have it in a second, because I want to go over like what is actually in this report. I have one right here with me. This is the actual report form that's going live on March 1st, 2026. There's 5 sections in this. Let me just give an example. Let's say you're a real estate investor. You own a property in your personal name, and now you want to transfer it from your personal name to an LLC. All right, you're going to fall under this rule. Well, what do I need to file? You're going to need to file a real estate report that includes the following information. 5 sections of information. First, who is filing the report? Now, maybe you're a lawyer. Like our law firm, by the way, my law firm, KKOS Lawyers, will do 200 deeds a month, transferring properties into LLCs for our real estate investor clients. Now, we will have to start filing this. We are considered a reporting person because we are either, and the reporting persons include someone filing a deed or the person actually recording the deed or preparing the deed even. It could include a title or escrow company that's escrowing the transaction that may also be preparing the deed. So any of these parties that are involved, whether you're hiring a professional like a lawyer to prepare the deed, you're hiring a title or escrow company, they are going to have an obligation to file. If you're doing it on your own, you're going to have the obligation to file this real estate report. So what's this mean? This means your cost for deed prep is going to go up because now anyone doing this has to also file this report and gather some information. Now, the information is not as onerous as the BOI. All right. It's similar, but there's one thing you don't have to do in this that is actually the biggest pain point in the BOI for any of you that remember the BOI. And that is no ID has to be sent in or attached in this real estate report. Under BOI, you had to include a driver's license or a passport of anyone that owned the LLC. But for now, let's go over those 5 sections. All right, so section 1 is who is the person filing this real estate report? Okay, and that's on page 1 of the real estate report. You're disclosing, in section 1, you're disclosing who is the filer of this. Let's say I was the lawyer. You hired me or our law firm to do this. We are going to be listed in section 1. Section 2, you're going to identify the property information. What's the address and legal description of this property? Okay, so you have to identify the property in section 2. In section 3, you identify the transferee information. Transferee information is who owns the property now. Like if I just transfer this out of my name to an LLC that I own, I'm going to put in the LLC that I own here. This is the transferee. The transferor is the person deeding the property. The transferee is the one receiving it. So if you're transferring out of your name to your LLC for asset protection, we're going to go over LLCs here in a second and all those asset protection benefits. But this is what's being included in the transferee. Maybe you're a real estate investor. You're buying this property using creative finance terms. There's no bank or financial institution involved. You probably are using a title or escrow company. Hopefully you are, and they're going to be filing this. But your entity receiving the property at the end is the transferee. Now, you have to list the entity information, the name of the LLC, the business address of the LLC, the EIN for the LLC. This could be a corporation too. And also, you have to identify anyone that owns 25% or more. You have to list the individuals that own 25% or more of this LLC, or anyone who has control of the LLC, like a manager of the LLC. All right. Or this could be president if you have for a corporation. So for most people, it's going to be you, the owner of the LLC, the real estate investor. So, and maybe you might have a partner in there. So anyone that's 25% or more, your personal information are going to be listed in this section 3 under beneficial owner. So you will list your name, your address, and your social security number. You don't have to include an ID or upload that, but you do have to provide your identifying name, address, and social security number. Now, part 4, this is the next section, is the transferor information. This is who's transferring the property to the transferee. Okay, so in the example I gave, this is you personally. You personally own the real estate. You're transferring it to the LLC. So you would provide your personal information here. Again, this would be your name, address, social security number. There are some exceptions here. I'm going to go over here in a second. If this is a trust, you would list your trust and list yourself as trustee and you as the beneficial owner as well in this section 4. Then section 5 is the payment information. You have to list the total consideration paid. Now, generally, if I'm transferring a property from my name to my LLC, there is no consideration. This will be a $0 or a $10 type thing that will be included here. And there's a box you can actually check for no consideration paid. Now, that is all the info going into this. There is one other identifying place of information that if there was money involved being transferred, which in the example I have here, you would check no money transferred. You won't have to fill this out. But if there was money being transferred, you have to list the bank account of where the money went. Okay. And this is part of FinCEN trying to get an understanding of these real estate transactions happening where there's no bank, there's no title company that, or at least a title company that's doing a transaction where there's a mortgage company or a bank where FinCEN would already be aware of what's going on because of what's happening with the loan applications and all those checks that happen there. So that's it. This is the real estate report. It's not complicated or like tricky in the sense of a tax return. There's no fee to file this thing. There's no tax for it, but it is a pain in the butt. It is one more stupid thing the government's making you do. And I'm sorry, but that's what it is. Now let's hit some exceptions though, because there are some exceptions I want to hit. And the first one is transfers from you personally to your trust. Those are exempt. Okay. If you're setting up a revocable living trust, we do again that all the time, hundreds of those every month in our law firm, KKOS Lawyers. We want to get your assets into the trust. This includes your properties, your home, or whatever other real estate you might have. So if it's your home, that would typically be owned in your trust. You will deed the property out of your name to your trust. There is an exception for that, where the owner of the trust is the same as the owner of the individual that's transferring the property. That's exempt. You do not need to do this real estate report. There's other exemptions there, but frankly, most of them aren't going to apply to you. They have to do with whether there's some bank or other financial or regulated institution involved in the transaction. That's not what I think most real estate investors are going to come upon or where you're going to be relying on an exception. So where I see the big need and the big cause for concern and awareness here for any of you real estate investors is deed transfers. And I want to talk about this for LLCs as we get into asset protection. The whole point of having an LLC for real estate investors is asset protection. The asset protection only works if you transfer the property out of your personal name into the LLC. Having an LLC without the property in it is absolutely worthless. We've got to get the property owned by the LLC in order for us to get the asset protection of the LLC. Because remember, the whole reason of having the LLC is the LLC owns the property. If something happens on the property, a tenant slips and falls, they can't sue me because I don't own the property. So we've got to get the property in the LLC. The problem is going to be not only do we have to do a deed now, we also have to file this stupid real estate report to FinCEN. And I'm sorry, I might be a little opinionated on this, but it just has to happen. Now, is it that complicated? No. When we're doing your deed at KKOS Lawyers, we will complete this for you. It's an extra $50 to do this real estate report on your behalf. And that way you're still getting the property deed in the LLC. I think most providers out there that know what the hell's going on right now in the world with FinCEN are going to be doing this. Whether you're using a title escrow company or a lawyer to prep your deeds, getting them into the LLC, you need to know about this. Now, any of you that are DIYers and you're doing the deeds yourself, you will need to do this. Okay. You don't get out of this simply because you did the deed for the LLC on your own. All right. Now we're going to take questions, of course, on this real estate report. We're going to take questions at the end of the show today. We got a lot we're going to cover today. It's not just about FinCEN. It's about how to use LLCs, as I said at the top, and also about using IRA LLCs and what the hell is that? Do I need an LLC for my IRA? We're going to be covering that. But most importantly, I want to make sure we're hitting your questions. All right. So if you've got questions, throw them in the chat. I got Jordan Hall here. He's going to be grabbing questions. I don't know if you have anything on this real estate report now. If you got one, throw it into Jordan right now. But otherwise, any other LLC questions, I want to hit those at the end. Do we got some stuff on real estate report?
We do,
All right.
and other questions
Okay,
too.
great.
But
Okay.
save those for the end.
All right.
We've got Dr. James. He asks, in a normal real estate closing, how do you figure out who actually has to file the real estate report and who's on the hook if it doesn't get filed?
Okay, good question. In a normal real estate closing, when you say normal, I'm going to say a bank's involved. All right. In a normal real estate closing, generally the settlement agent is going to be filing this. So like the title or escrow company is going to be filing this. FinCEN actually has a guide here. Okay. They have a guide, and I might not see this. I don't know if we have this and can share this, but this is who files this. Okay. The first person here is the closing or settlement agent if there's one involved. Okay. That would be the first person. The second one is the person that prepares a closing or settlement statement. The next one would be a person that recorded the deed. The next one is the person that prepared the deed. Then you've got the person who did the insurance policy, and it goes in order there. So for most closings now, if you're using an escrow or settlement agent, they will be doing this real estate report. Now remember, if there's a traditional mortgage or loan involved, this real estate report isn't filed. The reason is when you're applying for a loan, and the banks and the lenders are already running your name and information and the buyer's information through this FinCEN reporting. You just don't know it. It's happening on the back end. So they don't need this report. So this new reporting rule is really for these creative real estate transactions where a traditional bank is not involved, or where you're transferring property that you own personally into your LLC, where there's also not a traditional bank or mortgage loan involved. So great question. There is a reporting tree because there could be multiple people responsible to file it. But traditionally, if there's in the normal closing here, it's going to be the settlement or closing agent.
Okay, we'll knock out one more question.
Yeah.
So is this a continuation of the FinCEN reporting that was going through the courts last year, or is this a new requirement?
Okay, this is from the same statute, the Corporate Transparency Act, but this is a different rule from the BOI rule. Okay, it was different parts of the legislation. BOI was the one going through the courts. It was ruled unconstitutional, then ruled constitutional, then unconstitutional again. And then one court of appeals said it's constitutional, and another said it was unconstitutional. And then it went all the way to the US Supreme Court. And then right when it hit the US Supreme Court, the Trump administration came out and said, we're not enforcing this. This is a stupid rule anyways. It's burdensome to small business, and we don't think all of the cost and headache of it is worth any benefit for money laundering and all of that, the stuff they were trying to counter in the legislation. So it kind of became a non-issue. So that BOI requirement that could apply to any small business owner, anyone that owns an LLC or corporation, that one's dead. This is something totally different. So it's a separate rule, and it looks to be alive and well. Now, we were hoping there was going to be an exception for the scenario of, look, it's just me, Matt Sorensen, transferring it to an LLC that I own. Do I really need to file this thing? And right now, FinCEN says, yes, you do. And that kind of sucks, because I was shocked that was even be in there, because that's not really a transaction, right? We're just moving it to a different structure. But however, FinCEN disagrees. They still want to know what the hell's going on. So, all right. Okay.
Good.
Yes, we'll come back to any questions. So if you got questions on LLCs, we're going to be getting into it right now on just kind of nuts and bolts of LLCs, why we're using them, how to make sure you're structuring them properly, and kind of like, I want to kind of like reset some of the information that's out there on LLCs, because frankly, a lot of it's BS. There's a lot of bad information out there about LLCs, and there's a lot of just like myths and misunderstandings of why we're using an LLC. So I want to just talk about LLC structuring, and I'm calling this section reality versus BS. And I have to abbreviate that BS to make sure that this video doesn't get rated adult. Okay. All right, let's dig into it. All right, so we just talked about this FinCEN reporting rules, and let's stay on this theme, but because we're talking about all LLCs today. Now let's get into LLC structuring, reality versus BS. There's a lot of bad information out there, but the first question you should be asking is, why should I even use an LLC? Now, the number one reason, and this is a big one, is asset protection. We set up LLCs for asset protection. For you real estate investors, we're talking about the real estate LLC here and that use case specifically. You're putting the property into the LLC. And the reason you're doing that is if something happens on the property, a tenant slips and falls, there's a contractor issue, there's a vendor issue, they have to sue the LLC. They cannot sue you personally. Now, they can get a judgment against the LLC, but they're stuck there. All of your other businesses, all of your personal assets are protected. This is the reason we use an LLC. They can only go after what the LLC owns. Your bank accounts, your home, your investments, your other businesses, your retirement accounts, they cannot be touched because we isolated the liability in that LLC. And that's why an LLC is called a limited liability company. All right, so the primary reason again is asset protection. Now, just because your buddy said, I need 5 layers of asset protection doesn't mean you need 5 LLCs. Okay, there's a lot of people that are like, well, I've got a Wyoming LLC that owns a property LLC, that owns another LLC, that owns a series LLC, and they've got all these layers here and it owns one property. Okay, that's probably overkill. You need to get the right LLC structure for your situation. Now, but there's other reasons you might be using an LLC. You might have an operating business. Let's say that you're selling goods or services. You can be using an LLC for that. Maybe that LLC is taxed as an S corp because you have self-employment income when you're selling goods or services. By the way, you don't have self-employment income when you're doing rental real estate or selling a property for a capital gain. So you don't need to worry about the tax issues there. But if you have an operational business, you might fall into that. Now, in the real estate space, this can include flipping homes, wholesaling, Airbnb. All of those things are reasons you could be using an LLC, but they start being more of a business where you could maybe have self-employment tax. Now, an LLC with a rental property is still a business. I'm just saying in our mind, there's operating businesses and there's investment assets. A rental property is an investment asset. Wholesaling or flipping properties is like an operating business, okay? You're not trying to build wealth through the equity in the home or cash flow. You're trying to flip assets, okay? And that's a little different. All right, so another reason is the LLC creates legitimacy. You have a separate bank account for the LLC. It keeps your book clean. It keeps your personal life separate from your business life. And that separation matters from a legal standpoint and just practically to you to isolate your life and like, where am I spending my money? Where's the income coming from? Another reason the LLCs are very common is for partnerships. I have a number of LLCs with Mark Kohler. As many of you guys know, we do podcasts together, have multiple companies together. We have a lot of LLCs that we are partners in. All right. Sometimes I'm personally in the LLC as a partner and it owns real estate. And we have the asset protection of the LLC, but the LLC also has some partnership benefits. It has an operating agreement for the LLC. It says what percent I own, what responsibility and decisions we have, who's going to put money into it, how we get paid out of it, what happens if one of the partners wants to get out. Okay. So the LLC in itself has this operating agreement that operates like a partnership agreement. Why we love LLCs for partnership structures. Now, you could have your S corporation own an LLC if it's an operating business. You could individually own an LLC. Your revocable living trust could own an LLC or your share of an LLC, okay? But the benefits of the LLC start with asset protection. There's some business legitimacy. There's some partnership benefits. You might be using it for an operating business as well. And these are the reasons we're setting up an LLC. Want to know one thing I didn't mention yet? Taxes. We are not setting up LLCs to save on taxes. That is a huge myth that's out there. LLCs do not save taxes. LLCs are tax neutral. Most LLCs are a single member LLC, which is called a disregarded entity for tax purposes. Disregarded entity means the IRS treats it like it's not even there. So if I've got a rental property in an LLC that I own, and I own the LLC 100%, or my revocable trust does, that rental property's income or gain or loss is just flowing on to my 1040 on Schedule E in the same way as if I owned it personally. The LLC did nothing for me in terms of saving on taxes. It does not enable expenses or anything that you couldn't otherwise do personally. So the LLC is a great legal structure, but we're using it for liability protection and operational clarity, not as some secret IRS loophole, okay? All right, now, you can have LLCs taxed as S corporations, and I've mentioned that a little bit earlier here, and that's a tax strategy where I'm going to hit that in other lives. I've got other videos on my YouTube channel getting into using an S corporation and why you should have an S corporation. You can have an LLC taxed as an S Corp. That's for operational business owners. For you real estate investors, rental properties, we're just doing a regular plain old vanilla LLC that you own 100% typically, or your trust, or maybe you and your spouse. It's just flowing directly onto your 1040. Do not make an S election on that. Okay. All right. I think I beat that one to death on using an LLC for asset protection. If you didn't get that, that's just the main point. I use LLCs. I have rental real estate. The only reason is asset protection. All right, now we're going to be talking about a number of other things. And remember, if you've got questions on this, throw them in. I'm going to come back to them later here in the chat. But we're going to talk about IRA LLCs next here. So Jordan's grabbing questions there, but don't be shy in the chat, guys. If you're there and you got an LLC question, there's no dumb question. Honestly, there's probably 2 or 3 other people watching at least. They're going to be like, oh, I was kind of curious about that. I'm glad he or she asked that. So it's okay. I want to get your questions answered here, and it's free.
I know
you're not getting
take
a bill.
advantage of it.
Just it's free. All right. The advice might be what it's worth, but we're here, so let's do it. All right. Okay. All right. Now, some of you might have heard about an IRA LLC, or sometimes it's called a Checkbook IRA LLC. And so I've had somebody ask me because they saw one of my videos, and they're like, Matt, do I need an LLC for my IRA? And I said, well, it depends on what you're doing. What are you doing? Well, I'm investing in stocks and mutual funds. No, don't. This IRA LLC thing, that's not for you. The IRA LLC is for someone who self-directs their IRA. It's many of you real estate investors. Your IRA doesn't just have to own stocks, bonds, and mutual funds. A self-directed IRA is an IRA that can invest in real estate, private funds, crypto, notes, small businesses. And that's what we do. And a lot of my channel, I talk about self-directed IRAs. Our company directed IRA, we have clients, 24,000 accounts here, over $3 billion in assets, where they're using their retirement account. And this could be their Roth IRA, traditional IRA, HSA, Solo K, any of those accounts to go. But rather than buy a stock or a mutual fund, they're going to go make a real estate deal. They're buying a rental property. They're private lending their money. All right. Now, the difference here of a self-directed IRA is not the tax code. All right. There's no such thing as a self-directed IRA in the tax code. A self-directed IRA depends on the custodian you're using. So, for example, Directed IRA, my company, we are a self-directed IRA custodian. Fidelity is a brokerage custodian. All right. New York Life is an insurance company custodian. So when you have an IRA at New York Life or Northwestern Mutual, what can you buy with your IRA there? Annuities. Why? That's what they sell. When you have an IRA with TD Ameritrade or Fidelity, what can your IRA buy? Brokerage products, stocks, bonds, and mutual funds. Why? That's what they sell. Okay. So if you want to be able to invest in these alternative assets like real estate, that's a self-directed IRA. Okay. Let's just go over a simple example here. Let's say you want to buy a rental property with your IRA, and you want to do that because the cash flow on the IRA is great. The appreciation you think you can get on the rental real estate is better than what you can get from the mutual funds or stocks you've been buying. Now, if you have money at Fidelity and you call it Fidelity and you say, hey, Fidelity, I want to buy real estate with an IRA, Fidelity's going to say you can't do that. And it's not because IRAs can't own real estate. It's because Fidelity IRAs can't own real estate. So you'll need to move that account or a portion of those funds with a transfer. There's no tax or penalty to move your money from Fidelity to, let's say, Directed IRA or another self-directed IRA custodian. But once your money's at the self-directed custodian, you could say, hey, go buy the duplex on 123 Green Street with my IRA's money. When there's rental income coming in, it goes to my IRA. When I sell that property for a gain, whether I held it for a month or a year or 10 years, that gain goes all back into my IRA, no tax. Okay. I'm growing my retirement account and my wealth by investing in real estate because I believe it's a better asset and it's going to perform better than what I've been doing in the past of buying mutual funds or stocks. Okay. Now, if you're investing with a traditional IRA, remember those gains are going back into the traditional IRA and you're paying tax on the way out. This is a tax deferred account. If you have a Roth IRA, that money's growing and it's going to come out tax free later on in retirement. So if I'm out there in the real estate space and I want to use a retirement account and I want to do this self-directing, step one is I need a self-directed IRA. Okay. But you might want to use this structure called an IRA LLC. Because if I'm buying property with my IRA directly, and let's say you had an account at Directed IRA, and you want to buy the duplex on 123 Green Street. That's the investment asset your IRA is going to own. And you're going to have rental income and appreciation of the property. When that income is coming into the IRA, you're having to manage the transactions. All right. You've got to go say, hey, Directed IRA, sign the contract to buy the property. Hey, Directed IRA, deed the property into the name of the IRA. Hey, Directed IRA, pay the handyman that worked on the property. Okay, there's all this administrative stuff. But with an LLC, I get to be in control. When I have an IRA LLC, now my IRA owns an LLC 100%, and the LLC owns the property. Okay. And I think we have some diagrams on this. I want to show this IRA LLC, just like visually how this works, where I have my IRA owning an LLC, and the LLC owns the property. Now with this LLC, the LLC is going to have its own bank account. So let's say the property was 300 grand. And let's say I had a $500,000 IRA at Fidelity. I transfer 300,000 to my Directed IRA, and that 300,000 then went into this LLC. It's in the LLC's bank account. And we call this sometimes a checkbook control IRA because you have authority on the checking account. You're going to be manager of the LLC. Now, manager of an LLC is like president of the corporation. Manager of the LLC means you can act on behalf of the LLC. So now I've got the LLC and I can start investing it as I want. I can go buy the property at 123 Green Street, and it's going to be in the name of the LLC. Let's say I called the LLC XYZ Investments LLC. Now the buyer on the contract isn't my IRA, it's XYZ Investments LLC. When there's rental income coming in, it goes into the LLC bank account. When I have an expense on the property, I'm paying it out of the LLC bank account. All right. So this is where the checkbook control of the IRA LLC comes in. I have authority to act. I can move more quickly. And for real estate investors, when you have a rental property or you're flipping a property or you're buying property at an auction, you don't want to be waiting for your IRA custodian. Even though we love you at Directed IRA and we may want to help you there and we have great team and customer service, it's going to be better if you do it for yourself. You're going to be able to move quicker. Guys, I use this structure for my real estate investments with my self-directed account. Okay. I'm like CEO of the company and I know how to do all the stuff and the people to talk to. And I created half the forms that we have to do things. But I use this LLC structure because it's streamlined and easy when I'm doing real estate investments. Now, if I'm investing in a private company or I'm doing crypto, I'm not using this. Okay. You don't need this for that. You could, but you don't need it for that. For those you buy in real estate though, whether it's a rental property, a flip, buying property at auction, or you've got a lot of different assets, this LLC becomes a very powerful tool. Now, that FinCEN rule we just talked about before, that could apply to this. If you're buying real estate or doing real estate transactions with creative terms where there's no bank or financial institution involved that's lending on the deal, you may have a situation here where you're going to need to file this real estate report when you're acquiring that property and there's a deed prepared. Now, again, if you're using a title or escrow company, they're going to be the ones newly tasked here to do it. I'm sure they're going to charge you a fee for it. If you're using a law firm like us or we're working on the deeds, we will be including that, of course, in our deed structure as well. All right. Now, this IRA LLC is cool, right? Because it puts me in control. I can go invest in the stuff that I know and believe in. I've got a bank account, but there are some rules you need to know. And I want to talk about who your IRA cannot transact with. A lot of people, when they start thinking of like, what can my IRA own? They're actually surprised about how much open architecture there is for IRAs. You can really invest in anything. There's just 3 things you can't own. You can't own S corporations, you can't own life insurance, and you can't own collectibles with your IRA. Every other asset's fair game. Okay. So the big rule is not about like, what can your IRA own? The big rule you need to know is who your IRA can transact with. And there's a restricted list that you cannot transact with. So for example, you cannot transact with your own IRA. So if I own real estate personally, I can't transfer that property to my IRA. I can't sell the property from my name personally, Matt Sorensen, to Matt Sorensen's IRA, nor could I sell it to Matt Sorensen's IRA LLC. That would cause a prohibited transaction. because retirement accounts are like these tax advantaged accounts, Congress was like, we don't want to let you just transfer assets or buy and sell between yourself personally. We think you're going to manipulate the rules and get out of paying tax unfairly. So like you can use IRAs to go buy real estate or other investments, but you can't mix it in with your personal assets or buy and sell between yourself personally. Now, there's some other things you need to know here. You can't transact with yourself. You can't transact with your spouse. For those of you in Utah, this includes all of your spouses. You can't transact with your kids, your parents, grandparents, okay? Any of these lineal family members, your IRA cannot transact with. All right, now these are called the prohibited transaction rules. And if you do transact your IRA with any person who's prohibited here, your IRA becomes disqualified. All right, it blows up your IRA. You'll have penalties and taxes on it. So you want to avoid any of these prohibited transactions. All right, now there are a lot of different ways you can structure this IRA LLC. The first one is what we call a single member IRA LLC. This is where your IRA owns an LLC 100%. It's just one IRA account owning an LLC 100%. This is the most common IRA LLC. This is how mine is structured. I probably say 7 or 8 out of 10 IRA LLCs that we work with clients are just doing this structure. It's simple. It's a single member LLC. There's no tax return required. Now, you can have multiple IRAs on an LLC as well. This is called a multi-member IRA LLC. I can have 3 IRAs on an LLC, 2 IRAs on an LLC, 1 IRA and 1 individual owning an LLC, okay? And you're always going to break down the ownership of the LLC based on the dollars invested. Okay, so let's say, for example, this is a multi-member IRA LLC and it's my IRA investing in it and my spouse's IRA investing in it. And let's say that I put in 100 grand from my IRA and my spouse puts in 200 grand from her IRA. Well, the ownership is going to be broken up 1/3 my IRA and 2/3 my spouse's IRA. All right. So the ownership is always allocated on dollars invested. Now, the benefit of that multi-member IRA LLC is I was able to combine multiple portions of funds into the same LLC. The downside is this is a partnership tax return now. This LLC has more than one owner, so the IRS doesn't look at this like a single member disregarded entity. They look at this like a partnership, which means you have to file a 1065 partnership return. Now, there's no tax due on a partnership return, but you still have to file this with the IRS if you're doing a multi-member IRA LLC. Now, for those of you that are new to self-directing, this is advanced, okay? The multi-member IRA LLC may not be where you start, or you might need to get a consult with one of the lawyers, and that's included, by the way, when you set up an IRA LLC. But I don't want you to like automatically go to this. If you're brand new to this topic, there's other baby steps you should be taking learning about self-directed IRAs. The multi-member IRA LLC may be the thing you do out of the gate, all right? But I'm just saying it's not the typical first step. It is a little more structured and complicated, and there's more fees involved too to get that set up because you have multiple IRAs, which you have multiple account fees, and then you also have this IRA LLC that's a little more expensive to set up than a multi-member IRA LLC. But remember, the benefit is I can combine multiple IRAs into one LLC to go and buy a property. All right, now these IRA LLCs, you can have lots of variations of these, okay? I can have IRA money invested, individual money invested. We can have non-related people that are partners in it. For example, this could be my IRA putting in the cash and Jordan's doing the work, and we're splitting up the ownership based on him doing the work and me putting in the cash. Okay, so there's lots of variations of this and how we can structure this. Now, this IRA LLC structure, I want to make sure you understand, this is not a loophole, okay? This is about a better structure to control your investments, okay? It allows your retirement account to invest in real estate and alternative assets while keeping the benefits of an IRA intact, okay? And then used correctly, the IRA is very powerful. If you mess it up, though, and if you use it incorrectly, it can disqualify the entire account. We often tell clients, the IRA LLC, you should have some type of gun safety class with this, all right? It's just like buying a gun. You need to be responsible with this, okay? You can hurt yourself or others with this. And really it's yourself and your own account here that if you blow it up, I shouldn't use that word, but you know what I mean, okay? Okay, if you use it wrong, you use it improperly, your IRA gets distributed, you're subject to taxes and penalties. Now, the nice thing is we have a totally capable team at Directed IRA that can help you when you're setting up an IRA LLC. Our law firm, sister law firm, KKOS Lawyers. It's my law firm, I'm a partner in. It includes a consult. My book has an entire chapter on IRA LLCs. We have webinars, podcast episodes on the IRA LLCs. So it's not that it's complex. It's not rocket science. It's more like a board game. It's what I often say about self-directing in general is you just need to learn the rules. But once you've done it once or twice, it's the same thing over and over again. So just get up to speed on the rules. We're here to help. Of course, if you're interested in self-directing or using the LLC structure with your self-directed IRA. Now, there's a lot more you can learn on this, but lucky for you, we have a self-directed IRA summit. There's a whole hour on just the IRA LLC at the Self-Directed IRA Summit and about all the rules on self-directing. That is April 17th. It is virtual only. This is full day on a Friday. We are going virtual from the studio. We're going to have some stuff on the streets. We're going to have other self-directed investors talking about their successes, things they've done right. We'll have other experts in different areas. I'll be speaking. Mark will be speaking. Mark Kohler, CPA attorney. It's going to be an awesome presentation and jam-packed with information. This is kind of like, I would say, this will give you your confidence throughout self-directing. If you're someone that's been on the fence about it, or you're like, I need to learn more about it before I take the next step, that's what we did the Self-Directed IRA Summit for. Now, if you're already a Directed IRA customer, it's free. Okay, in our newsletter, we've been giving a code for Directed IRA customers where you can get it for free. So make sure you're subscribed to the newsletter. You can email us at clients@Directed IRA as well. And we'll check if you're a customer and give you the free code so you can register. Everyone else has to pay a fee, but we're trying to make it easy to enter. I believe it's $100. Well, is it $100 now, or is it the fee went up? 200.
It's gone up. Yeah.
Okay.
Yeah.
It might be 200, but it's worth hundreds of thousands. Okay. If you implement the strategies and over time, I really think it's that valuable. Seriously. So we'd love to see you there. Okay. That's April 17th, Self-Directed IRA Summit. All right. We ready for questions?
We are. We got some good ones. All over the map too.
All right. Let's hit the questions. I love it.
I'm going to start with the question that is relevant to the FinCEN reporting.
All right. Let's hit the FinCEN questions.
All right,
let's those. Go. This is newsy, guys. This is cutting edge.
This is from Chandi 2000. And shout out. Chani's been here and asking great questions for at least 3 of our 4 office hours.
Thank you for being on.
Yeah, regular.
All right.
Would this...
We're 4 in. I think we can start giving people the regular title.
I mean, Chandi is.
We're 4 wealth office hours in. I like it.
So would this essentially kill privacy if there was a possibility the public can FOIA, Freedom of Information Act, this info?
Great question.
Also, how will the government actually enforce transfers without financing? Look at state records.
Okay, good questions. Okay, on the first one, this is in the law, and this is also in the guides that FinCEN is putting out. Real estate reports are not accessible by Freedom of Information Act request. So the government can deem certain stuff classified or personal information, just like your tax return. Someone can't make a Freedom of Information Act request for your tax return. Okay, so this is kind of similar, falling into that category. Other government agencies don't actually have access to this either. They have to like subpoena FinCEN to get this information. So this is not publicly accessible. This will not be publicly searchable, and no one can do a Freedom of Information Act request to get a real estate report to try and get some of your personal information, or to try and understand who owns an LLC even, which might be a good thing they're trying to understand for some good reason, or maybe they're just trying to be nosy. But your privacy will still be protected, but you have to disclose it at least to the government. So it's protected from other sources. I know it sucks, and we'd rather be more private, but this is the law we're dealt. The other part about this is how will they know is, yes, they could scrape transfer records with, counties. Most of the county's information is all online now. So the federal government could just be scraping information and being like, was a real estate report filed or not? And there are penalties for noncompliance on this. There's even criminal penalties for noncompliance on this. So you want to make sure you're abiding by the law here. This is going into effect on March 1st. But the first part, at least we know it's private and not subject to a Freedom of Information Act request.
Okay. Let's see. We're going to go with a fee question here.
All right.
So basically, it's from Dean Shull, 4063. I feel like I've seen that name too. For taxes, are their clients, and they want to know, are any of the fees we pay for solo 401ks for their S corp, is that a write-off in taxes?
Okay, yes. So let's say you're an S corporation owner, you're a business owner, and you're setting up a solo 401k. And the fees you pay to set up the solo 401k and your annual account fees, have the business pay those. Put that on the business card. That will be an expense for the business. Also, we did a video and a webinar actually at Directed on the tax credit for solo case setups. Okay, there is a $1,500 tax credit for adopting an automatic contribution arrangement in your solo 401k. So let's drop that link in there on the solo K.
And we've got an article too
that we did. We have an article on this. Jordan
painstakingly
Jordan,
written. Yes.
Jordan had to write
Yes.
most of the article, so he's like, let's. Did you get a byline on that?
No, not at all. Okay. I might add that.
We should. I think we should. I think we should. But that's a good thing to know, because this is a tax credit. So I'm expensing what I'm paying for this in the business, plus you can get a tax credit. Right? It's up to $500 a year over 3 years for a total of $1,500. This works even for you that have solo Ks already. By the way, you set it up 5 years ago. You can adopt this automatic contribution arrangement structure in your solo K, get a $500 tax deduction for 2026, 2027, 2028. So take advantage of that. It's a nice little tax credit out there. It's one of the few things small business owners are getting.
Want to mention really quick too, any article or any resource that we're referencing, we're going to have that in the comments section in the video. So if we're missing anything, please comment. This will go live. Like, you'll see this even after today. And if we're missing anything, let us know. But we want to make sure that we get everything in the comment section. Next question we've got here is this is from Vladimir RM8. At what point would you advise using an LLC in terms of how many properties they have? Like one property, 2 properties, 3 or 4?
Yeah.
At what point would you engage with that?
Great question. For those of you that own multiple properties and you're trying to decide how many LLCs to set up, we don't really care about how many properties you own. We want to look at how much equity do you have in the properties. All right. Now, first, before we even get to that question, I want to make sure you understand how an LLC works. Let's say I have 5 properties and they're all owned in the same LLC. But let's say the tenant slips and falls on property number 2. Well, that tenant can sue the LLC and get any equity or assets in the LLC. So all 5 properties are at risk. Now, they can't get to me personally. They can't get to other LLCs, but anything in that same LLC, the plaintiff here that will have a judgment against you if they prevail, and you go past insurance, all the things, okay? So all your properties could be at risk here in the LLC. Now, does that mean I do a separate LLC for every property? No. Let's say you had 5 properties in an LLC, but they're all mortgaged to the hilt. You refinance them whenever it's possible. You have $10,000 of equity in each property for $50,000 of total equity. In that case, I'd say just keep them all in one LLC. All right. There's not a lot of equity to protect between the properties. We're getting the liability protection from one LLC from all of our other assets and our personal assets, but I don't need to protect the equity between the properties. On the other hand, let's say you have 5 properties. Each one of them has $200,000 of equity. You've got $1 million of equity between the 5 properties. I would probably put those each in their own LLC, or maybe it's 3 or 4 LLCs, okay? Because now I've got enough equity where it's worth protecting. I don't want to have all my eggs in one basket, so to speak. So in that instance where you have properties that have a good amount of equity, we usually draw the line at 200 or 250K of equity. We think it makes sense cost-wise to have a separate LLC. All right, now everybody has a little different theory on that. You could be doing that at $500,000 or whatever where you want to draw the line in the sand. But obviously there's a little more cost to having more LLCs. So we don't want to automatically do that for every property, but we do want to do it where the asset protection will pay off, where that risk and that ability for me to limit my risk to just what's in that LLC becomes more valuable, because your asset protection benefits increase as you have more worth and equity to protect. All right. The more equity I have to protect and the more assets I have, the more LLCs and structure I'm going to have. All right. So we're going to look at how much equity do you have to determine how many LLCs you have if you have multiple properties.
We're getting through a lot today.
Yeah.
We got
That was a
three
great
more.
question.
Yeah, we got
All right.
3 more. All right. So from 602 J Perez, when should you establish a holding company LLC?
Good question. Holding company LLC. Can I use the whiteboard here? Because I want to maybe show people what the hell that is. No? I mean, I can turn it on. Is it plugged in for this? Oh, okay. Sorry. I can do that part, guys. Okay. Last time I was
Tristan
doing
wanted on
this,
camera.
yeah. When you weren't here, Angel, I had Tristan here, and I was like, go to the next slide, and the slides were all on the iPad right here. Did you see the recording? Okay. I felt like an idiot for the whole week, Tristan. Okay. And
That was the highlight of Tristan's week. So,
yeah, it was like, bro. Okay. It's hard. It's hard working with Matt Sorensen. All right. Okay. Let me show you what a holding company is here. Okay. So let's say we have the rental property. Okay. That's your piece of real estate. Now you're going to have an LLC here, and we're going to have an individual owner down here. This is you, or this is really your revocable living trust if you have a trust. Now, if I just have this structure where this is me, I own an LLC, my LLC owns the property, right? I've got liability protection here. If something happens on at the property level, they can sue the LLC and they can get after anything the LLC owns, but they can't come down here to me personally, okay? That's the limited liability protection I have. Now, some people will say, well, Matt, why don't I have another LLC in the mix? And let's just pop one in here. And I'll have this holding company LLC. And maybe it owns another LLC that owns another separate property, okay? And then I own it like this, okay? So you could do that. If you don't have $1 million of net worth to protect here, don't do this. It's overkill, okay? You're buying something, you don't need this, okay? You're like getting the bus to move 1 or 2 people around, okay? It's overkill. I don't know. That was the best I could do with an analogy. I was like, you got an excavator when you just need a shovel, okay? Okay.
Chainsaw when you need a scalpel.
Chainsaw, okay, yeah, when you need a scalpel, or the butcher's knife, whatever. You guys know what I'm saying, okay? So this is what the holding company is here. The holding company, what that means is it doesn't own anything or do anything itself. It just owns other companies, all right? And these companies own properties, or they could own other businesses. Now, we do use this sometimes in Wyoming, or we will use a Wyoming LLC as the holding company. It's not giving me any asset protection more, okay? I already have that. I don't need another LLC to protect me from the liabilities of the business, okay? That's what most real estate investors are trying to do, or most business owners in general. You have an LLC for your business or for your real estate investments. You're trying to protect anything that goes wrong in the business or the LLC from coming down to you personally, right? And that's protected because I have the LLC up here and I have this thing called the corporate veil. But let's say you're trying to protect the properties and your assets from yourself. This is different, and this is where you may use a holding company, and Wyoming is a common place to do this. Let's say you personally have a judgment against you. It's not in your business, it's against you personally, but you have valuable assets in LLCs. Generally, if you don't have a holding company, a lot of states, they'll allow a creditor to go into any LLC you own to force you to sell assets. But in Wyoming, there's something called charging order protection that applies to single member LLCs like this that is unique in Wyoming. There's charging order protection in most states, but it generally only applies to LLCs with multiple owners. But in Wyoming, they said, we don't care. One owner in this, we give charging order protection, which says if the owner of the LLC has a judgment against him, the creditor on that judgment can get up to the LLC here, but they get stuck. They can't get up to the next LLC and get to the assets. All right. So this holding company structure is really kind of a more high net worth thing. Maybe you're someone that has a lot of liability in your personal name or risks personally, where you have a lot of assets in LLCs. You may want to implement the holding company structure. I will say 9 out of 10 clients at our law firm, KKOS Lawyers, We're not doing the holding company structure, and we're not even considering it or putting it on the map unless you have more than $1 million of net worth. Because again, we don't want to have too much structure and overstructure you and overcharge you, frankly, for entities that don't provide value yet. Let's say you're just getting started. You've bought one rental property. Let's just do one LLC. Let's say 10 years later, your net worth is doubled, tripled, or gone 10x. We can add the holding company in later. It's okay. Let's add the asset protection in when it makes sense and when it fits. So long answer, but that is quite a complicated question. And I do have a YouTube video too on Wyoming LLCs, reality or BS. So you might want to check that video out too. All right, last question.
We got two more,
Okay,
and
right.
YTE being
Okay.
he really asked us a two-parter here.
Okay.
So we'll try and tackle both of these. Maybe I have an LLC that manages all my rentals, collects rent, pay vendors, and pays landlord. Can I use this LLC to collect rent for a property in an SD IRA? I understand that I can't get paid.
Yes, do not do that. Do not do that. Keep the LLC for your personal rentals and other operational stuff you're doing separate from your self-directed IRA. That self-directed IRA money, even the money in an IRA LLC, that's like sacred money. Do not mix that in with personal LLCs or personal bank accounts. That will cause a prohibited transaction. Okay. Even if it's then going right from your personal account to the IRA or the IRA LLC, don't do that. It'll cause a prohibited transaction. There's not an exception for it either.
Okay. The second part, I learned that you can use a land trust on a title. Will it be a prohibited transaction if I serve as the trustee and property manager for free?
Okay. Lot there. The question was, if I'm kind of serving as the property manager on a property owned by my self-directed IRA, this is whether it's owned in your IRA, in a trust, in an LLC. I'm not a fan of land trusts for self-directed IRAs, by the way. That's a tangent point. I know some people use them. I think they don't make sense. We recommend using an IRA LLC. Trusts do not have asset protection. All this, what I was talking about there, your LLC owns a property, someone slips and falls, they can't go after you. They have to sue the LLC. That doesn't apply to a land trust. They can blow right through the trust and get to the owner of the trust, which would be the self-directed IRA, or the trustee of the trust, which is you personally. So we don't like the land trust. Separate little conversation. To the question though, can I do the property management and handle things with respect to the self-directed IRA property? Yes. What the IRS allows you to do when your IRA owns real estate, or you have an IRA LLC that owns real estate, is you can do administrative and management functions. You can go to the property. You can show it to a tenant. You can write a lease. You can tell them where to send the rent check. You don't put it in your personal bank account. It can go in the IRA LLC bank account or into your trust, land trust, if you're using that structure. Again, I'm not a fan, but you could be using it. There's people out there that like that. Or it could be going directly to the IRA, but it's not getting deposited into your bank account. Where you can cross the line, though, is providing physical services. You can't go put on the tool belt and go improve the property. You can go to the property and tell a contractor what to do, and the IRA or IRA LLC is going to pay them, but you can't go work on the property personally. You also can't get paid for doing anything with respect to the IRA or IRA LLC, okay? You can't pay yourself a management fee or pay yourself a salary from the IRA LLC. That also causes a prohibited transaction as well. So, and a lot of that stuff, by the way, again, I'm not meaning it's just, today's show is brought to you by the Self-Directed IRA Summit, brought to you by Directed IRA this April 17th. Be there. Okay. It's not, I didn't mean to do that, but you will learn the rules of what you're asking here at the Self-Directed IRA Summit.
All right, we're going to end it with, and because Holistic Mama has been very patient, she was actually one of the first questions, and I think we tackled it in the chat, but figured we could just do a TLDR, a quick take on Trump accounts. So truly trying to understand Trump accounts and if it's actually worth it.
Yes.
What's your take?
I think it's worth it. I like the Trump accounts. Now, it's a no-brainer if your kid was born in 25 through 28 in those 4 years, because you get a free $1,000. Okay. That's like the government's just giving you $1,000. You can go let it invest. By the time your kid reaches age 18, it'll be 10, 20 grand. Okay. From all the compounding over time, even if you don't put any more money in. All right. So that's a no-brainer. But I think even for those of you, and I have stepdaughters that are 11, I told my wife, we're doing these Trump accounts. Okay. Because you can put $5 grand a year in per kid to this Trump account. you don't get a deduction. And my first look at this, I didn't think these Trump accounts were that great, because I'm like, I don't get a tax deduction. Is you invest the money, and you have to invest it. You can't self-direct this, by the way. It has to be invested into ETFs or funds that are invested primarily in the US stock market. So there's going to be a lineup of different funds that you can invest into, but you can't invest internationally. You can't buy real estate or crypto or doing these alternative assets. So you're buying this ETF fund, which is fine. Okay, we're investing in the US stock market. That usually does pretty well over time. And but as that money comes out, once they hit age 18, you pay taxes as you pull the money out on the gains and all the growth. Well, I was like, that kind of sucks. Like, I don't get a tax deduction for the money in, and I pay tax on the way out. That doesn't sound great. At least in a traditional IRA, when I put my money in, I get a deduction. It grows and I pull it out later in retirement. I pay tax on the way out. But the Trump account, I don't even get the tax deduction on the way in. But there is one trick. And this is the very first Wealth Office Hours we did on Trump accounts. I talked about how you can convert the Trump account to a Roth IRA. And this is confirmed in the Treasury regs that came out on Trump accounts at the end of last year. There's a little section in it. It was like this golden nugget to me in the regs on Trump accounts that said when the kid reaches age 18, their Trump account effectively turns into a traditional IRA, which enables them to convert it to a Roth IRA. Now, if your kid, and you're smart about this and you're helping your kid, you will have them convert when they are in low or no income years. When they're in their teenage years, 18, 19, or they're in their 20s, start converting their Trump account over to a Roth, because then they will have a Roth IRA that's going to grow and come out totally tax-free. You do pay tax when you convert any of the gains in the Trump account to Roth. There is tax on that, but they're going to be in their lowest income years, in their teens and in their early 20s. It'll be the best time for them to convert. Now, if they are no income and they're dependent of you, you might have the kiddie tax, okay? But if they're on their own and dependent, not on your tax return, they will convert, and they might be in a 0 income or a 10% income tax bracket. And that's going to be a great time for them to convert that Trump account over to Roth. So now I love the Trump account because it opens the door for any kid to have a Roth IRA. It just takes some planning now, getting the money in year over year, and then doing that Roth conversion strategy in their late teenage years or in their 20s when they're going to be in lower income years. And the cost of that Roth conversion is going to be relatively low to the upside benefit they're going to have of then growing this Roth IRA over a 40-year investment horizon now. Because now they're doing this at 20. They're not going to access that money for 45 years maybe until they hit 65 in the Roth IRA. And I even ran the numbers on this. We looked at that. I think it was even 60 grand put into a Trump account, and you don't put any more money in. The kid converts that to a Roth IRA in their 20s. When they hit age 65, assuming they invested and got the S&P 500 returns, that Roth IRA will be $8 million. They're not putting any more money into it. So I do love the Trump account, but I like pairing it to the Roth conversion strategy and getting them a Roth IRA. Okay, that was a little long. Remember, that's the first episode of Wealth Office Hours Live. I got a separate video on it too. Watch out for the kiddie tax. That question came up actually in the first Wealth Office Hours Live. And I've looked into that a little bit. It really depends if the kid's still a dependent on your return in their 18, in their early 20s, maybe they're in college and you're trying to claim them as a dependent. That will cause a kiddie tax problem. So don't have them be a dependent of yours. Once they're not a dependent, start doing that Roth conversion strategy. All right.
That's great.
Okay. Well, thanks everybody for all the questions. I hope you learned something here at Wealth Office Hours Live. Sorry that some of this was bad news on the FinCEN real estate report, but it is something you do need to know. We want to make sure all of our real estate investor clients, all of you that are subscribed and following the channel, are aware of this. This is important. We want to make sure we're complying with that. Again, if you're working with my law firm, KKOS Lawyers, we will be helping you do this when we're transferring properties from your personal name to your LLC, or you're doing creative real estate structures where there's a deed of the property to the LLC. We'll make sure that that real estate report gets done. If you're working with title companies, you're doing things on your own, remember, you can go to fincen.gov. It is the real estate report. That's exactly what it's called. It sounds like a weird generic name, but that's what they call it, the real estate report. And that is where that form goes. This starts March 1st, 2026. Now, we will be back next week And we're here every Thursday at 4 p.m. Pacific time on Wealth Office Hours Live, trying to give you ideas, strategies, and answer your questions about growing and building wealth. We'll see you next time.